Okay, we're running out of time in this class, so we have to press on and wrap things up. We've actually covered all of the core material now that I intend to present in the class, and all that we have in front of us is to go back and sort of summarize and put things together and draw some general conclusions and take a practical orientation toward things. And so I'm going to deliver this lecture today. I won't quite complete it today, and continue it on Monday. And then I'm going to say a few sundry things of wrapping up the class. And then we have our examination on Wednesday. And I'll talk more about that in just a minute. There's also a video that is actually the concluding lecture that is posted for this class. That's lecture 13. And so that's not this lecture. That's a video lecture that goes through and provides some sort of generic summary advice for people to consider as you try to blend together all of the information that you've learned in this class. We're going to end where we started. We're not going to say much about this today, but I'm going to come back to this on Wednesday. Remember, I sort of started this class out by talking about income and wealth distribution in the United States and pointing out that the reason for the distribution is not that hard to figure out, and how one sort of taps yourself into the portion of the distribution that allows you to move into the upper 10% or 1% isn't all that hard to figure out either. And so I want to return to that. When people ask me what I teach in this course, like other colleagues, other faculty members, I sort of give a tongue-in-cheek answer that's half serious and half not. And I tell them that I realize that this is largely a professional school, and that I'm aware, because I'm on the budget committee, that almost 70% of the parents whose children come to this school are already members of the upper 10%, and quite a subset of those are members of the 1%. So it's my job to make sure that their children stay in that income category and wealth category for the rest of their lives. And if they're not there, to move them into it. And then they can't figure out whether I'm serious or not, because we're supposed to be a liberal arts college with liberal objectives, not such concrete objectives as that. But of course, I'm quite serious about that. Your parents are actually interested in you doing well, and you're interested in doing it yourself. There's more to the story than that. In case you're wondering, though, about what that threshold is or what that breakdown is, you can base this down based upon family, based upon households, different ways to measure these criteria. But if you use the standards used by the Economic Policy Institute, as they break it down by individual income earners, and this is for income and not wealth only, then the top 10%, the threshold for that's only $118,400. And so that's why I say that you come from families that, for the largest part, are in that category rather easily. And even the top 1% is perhaps not as high as you think it is. It's not $1 million. It's $718,000. And you can see there on the graph on the right that the percentage change in compensation has largely gone to that top group, which has been the complaint coming from many over long periods of time. So we'll say a little bit more about that in the conclusion. It's not inconsistent for you to want to be in that group, while at the same time believing politically that it's not healthy for the economy to have this maldistribution of income. Those two are completely compatible with each other. Now, let's talk about the exam, because I'm sure that's beginning to I have the wrong slide already right off the bat. I got to change this. I posted the wrong slide here, pulled the wrong slide in. What the hell? Where's my... Oh yeah, that slide actually shouldn't even be there. Should have taken it out, is what I should have done. Thank you for updating this. So let me take that out. That's not even supposed to be there. Cut. Okay, there we go. So the next slide. Okay, so before we get to that, yeah, so I added a new exam slide, but I forgot to take the last year's one out. So at any rate, just so you'll know, the Rex Azabor won the portfolio competition with a portfolio that had a weekend value of $142,000. And I went back and checked his original submission, and it's legitimate. And the reason that he won is because he invested about a fifth of his money in Stage Stores SSI, which went from a value of about 80 cents per share to $5 per share over the few weeks of the semester, and that was responsible for almost the entirety of his gains there. But that's the way this stuff works, right? And that is a New York Stock Exchange listed stock. That's not an over-the-counter stock. It had just been doing poorly and had a bit of a recovery. So I sent him an email. I haven't heard back from him yet. So he gets to choose between a Vortec Poker 3, a mechanical keyboard, which is what this is, except the one that I'm offering him is backlit. Because students tend to like these 60% and 65% keyboards, kind of portable. Or a Ducky Shine 7 or any Ducky keyboard that he wants with Cherry MX keys. And so he's got to tell me what he wants. I'll place it on order for mechanical keyboards, and if it's in stock, he'll have it before he leaves for the break. If it is back ordered, he'll have to wait until the semester starts, and I'll give it to him then, as I typically do. So that's how that ended. Now, for the final examination, the final exam is given in class on Wednesday, December the 11th at class time. And I was thinking at the beginning, I was trying to figure out whether I wanted to give a take-home exam. And I noticed that in the course calendar, I said that I was going to, but I've decided some time ago that I'm not. And the reason I'm not is because this is the last time teaching the course, and I don't want to. Now, the reason that there always has been a take-home exam is because, as you know, the rules at the colleges say that we're supposed to give you your final exam during finals week, not in the last week of classes. But it turns out that these late afternoon Tuesday and Thursday classes have their exams scheduled at the very, very end of the finals week, very late in the day. So years ago, I surveyed students and said, what's your preference? Do you want to actually have to hang around? Because I'm not giving the exam early. We're going to give it when it's scheduled, right? You want to hang around until 10 days later, then take the exam late in the week, or do you want to take it on the last day of classes? And the vote was 90-3 that they wanted to take it on the last day of classes. But to not violate the rule, because the rule says you can't do that, then I actually called the final exam the third exam, and then the take-home exam was the actual final. And so I always split the exam into parts where the in-class exam was worth 160, the take-home, which was a single essay question, was 40. And that way we didn't comply with the spirit of the rule, but at least we complied legally with the rule. And that's why I've always done that. And but I said this year, who cares, right? What are you going to do to me if I break the rule? I'm leaving anyway. So all they can do is speed that up, which would be fine with me. So we don't have a take-home exam. You're doing it all on the last. And I think if you think about it, that kind of rushes things for you, but most of you would kind of like to get it out of the way, I presume, anyway, right? Especially if the option is taken at the very, very end of finals week, which is where it would be because it's a late afternoon. Tuesday, Thursday, and that's when those exams are taken, okay? So it is given then on the last scheduled day of this class on December the 11th, on Wednesday. The exam will be nearly identical to the second exam, exactly the same structure, 40 minutes as before, and ending with, say, 20 or so matching questions at the very back. And we'll cover only the material since the last exam, which is modules 7 and that should say 8, not 9. Jeez, 7 and 8, or maybe it should be 8 and 9. Let me check and see what it's supposed to say here. No, I don't want you to make sure we get this right for the record. I don't want no internet. I have the internet. Oh, that's right. I don't have the internet. Okay. Jerome. Cadet. Let's kill that and start all over again. Let me make sure that I've got this right. Since there's no option to get it wrong. So there's Okay, 104, course calendar. Okay. 7 and 8 is what we're covering here, okay? So. Okay, so now it's correct. 7 and 8. Okay. The exam review video will be posted probably tomorrow, actually, because I have the text done. All I have to do is record it, so I'll probably do it tomorrow. But if it's not tomorrow, I guarantee it'll be posted by Friday, December the 6th. And the instruction letter for ADA students and other students needing special consideration will go out Thursday or Friday also, so you could expect that if you're one of those. And the comments on why the exam can't be given early and must be given under restricted conditions, that's partly what I've already said. If I make this mic too loud, it's going to feed back into the YouTube mic, and that's going to cause a problem. So I guess you'll have to hear some banging from time to time. Now, but some people ask if I can give the exam early. Because of the kind of exam it is, I can't. You know, it's an online exam. You see how it works, right? I can only really give it 2 or 3 times, and the security of the exam breaks down if I give it more than that. And so I can't give it to one person early because that exposes the exam to everybody that's going to take it, and that isn't going to happen. So it has to be given under restricted conditions, which means not only can I not give it early to people that would like me to, I really can't give the makeup or whatever more than just one time. So everybody's got to figure out when we can all meet for things like that. That does cause some problems with the students who are conflicts and with the ADA students, but I iron that out to where I minimize the number of times I can give the exam while keeping the exam secure. And you have to remember that when I seem to be unreasonable because you just want to take it at a time that's convenient to you. I usually can't do that. All right, so let's talk about managing your wealth now that you have all sorts of means to actually do that. And if you go back and take a look at this title, the title implies that we're talking about portfolio management and portfolio rebalancing. And we're going back to that subject that I first introduced to you early in the course in the section on mutual funds. Because again, I pointed out that the primary orientation of this course is toward long-term family-level financial investing that's actually intergenerational, potentially, where you're investing for long periods of time and even generation carryover for long periods of time. And so that involves typically not choosing stocks or jumping in and out of options, contracts, or futures. You can do that if you want to try to supplement your yield and you think you can supplement your yield, but for the largest part, for most of you, this means managing mutual fund and or ETP portfolio for the largest part for the rest of your life, and doing it wisely enough to make sure that your wealth accumulates reasonably over some period of time. Now, we introduced at that time the concept of the balanced portfolio, or the portfolio where, depending upon your age and your attitude about risk, you decide the mix at a minimum between the equity component of the portfolio and the yield-bearing component of the portfolio. And as I said then and said since then, and we'll again say now, and we'll say in the final video, that's just about all the financial information you actually need to have to optimize your lifetime wealth. You don't need to remember hardly anything I told you about options or futures, except to the extent that if you're considering moving into the exotic instruments that they offer, remember all the warnings I gave you about how some of them are simply not suitable for retail level investment or especially long-term retirement investment. That is important to try to remember. The rest of this is stuff you can generalize and stay on top of and don't have to work hard to remember. Now, you start off and say, well, what balance should I start at? Would I, for example, begin with my 401k on my first job or something? Again, that kind of depends upon your attitude about risk And it depends upon how long an economic recovery has been going, given the timing of when you enter the job market, or whether we're coming out of a recession, and to some extent common sense. And so for the largest part, the general rule of thumb is the more risk adverse or older you are, the greater the bond representation in your portfolio. And aside from that, that's a judgment call, right? You just say, well, 70-30 is where I want to be, or 80-20 is where I want to be, or 20-80 is where I want to be. And so for the largest part, we can start off by saying that if you're young and you're a risk taker, and you're moving into you're building up your investments at a reasonable time where it doesn't look like we're on the brink of some kind of collapse, then an 80-20 balance is a good starting point. Now, a lot of people recommend, and I sometimes say, if you know what you're doing, I tend to approve of the notion of 100-0 as you're starting out. I don't know if I would say that now, though. This is one of the longest recoveries on record, and it's been fueled by easy money policies that at some point have to stop. And it's in a troubled world where global trade continues to be hampered by political considerations that aren't being resolved. And so I don't think I would recommend to anyone now that you have equity representing 100% of your investment portfolio at the present time. But under, say, 5 years ago, though, 100% might have been a reasonably good idea. Or in retrospect, it definitely would have been, because the market's almost doubled in the last 5 years. But again, very easy to see it backwards, not so easy to see it going forward. So the more traditional young risk adverse is 70-30. Neutral, if you don't know what the hell you're doing and you say, I never want to ever make this decision again, then 60-40 is where you probably need to be. And anyone above 50 that already has a lot of progress in building up your wealth targets, 60-40 is, again, a suitable and neutral target for someone in that group. If you're already funded entirely, which is going to be the case for most of you by the time you're 50 or 55 years of age, then 50-50 might be what you choose. And then finally, if you get above 60 and you're risk adverse, or you're simply so substantially funded it doesn't matter anymore, 30-70 or even 20-80 is where you're going to be. I get a lot of inquiries. I don't like answering these emails from people I've known over the years about where they should be on this kind of thing. And I said, why don't you look at my lectures and decide for yourself? I don't want to give you financial advice, but they pester me. And I end up saying to them, if they're 65 or so, go 20-80, or just go everything in intermediate term bonds. You've got enough money to retire on in spades now. Just stay away from the stock market now. But don't blame me if it continues to rise another 40%, because markets do that all the time. That represents a naivete about risk. So these components are rough guidelines based mostly on age and proximity to retirement, but it depends upon your attitude about risk and how nimble you think you are in responding to changing markets and whether you would be able to do that, and the extent to which you want to manage your portfolio. If you don't want to manage your portfolio at all, you just hate this stuff, then just keep it at 60-40 or 70-30. Or keep it at 70-30 most of the time, and then when you start getting concerned because you occasionally look at the news and see that things are turning south, then move it at that point to 60-40. And then as you get older, move it all the way to bonds for the largest part. However, the issue arises once you start, whatever you set up as the portfolio target will never be maintained because of the asymmetry in how these markets perform. So at a minimum, you have to rebalance no matter what you're doing and what your target is every few years. And this lecture is actually about that rebalancing effort and how you should approach it. Now, again, so we'll sort of break down this multitude of portfolios into three to make this discussion a little bit easier. So here we have the low-risk portfolio we're describing as 60-40, suitable for someone who's retired and approaching retirement, especially if elderly with adequate wealth, and relying upon this portfolio for covering expenses. This is a healthy times low-risk portfolio. If you believe that you're in dire straits, then true aversion may require a 70-30 mix or even an 80-20. And I would say to anybody right now, if you're 70 years of age and you have all the money you need, you should be in 80-20 or have no stocks at all at the present time. And if the Dow goes up 400, just get over it. because the day that the Dow goes down 1,200 will be the day that you wish that you had thought along those lines. The mid-risk portfolio is 60-40 the other way, 60-40, I mean, this is low-risk portfolios, mostly bonds. The mid-risk portfolio is 60-40 the other way. And then finally, the high-risk portfolio is 70-30 or even 80-20 or even 90-10. And this is for the smart, involved, younger investor who at least is beginning to invest at a time where there's no reason to believe that you have an imminent recession and the country appears to be relatively well run and you live in what appears to be a relatively stable world. I don't know if you'll ever see that world in your lifetime again, but you might. And so if you do, then maybe you can go back to an 80-20. Now, so the discussion is about rebalancing an active or aggressive managed portfolio. So this requires frequent monitoring and adjustment for economic conditions. And I actually advise people, even if you don't like this stuff, to sort of take a look at your portfolio. Most of you will be married, so do it with your spouse. Say quarterly, once every 3 months. Just take a look at your portfolio and see if it continues to make sense to you. And then it's, I think, a good idea, unless you really want to get into this stuff, to keep very simple portfolios, typically mutual funds, of just a handful of mutual funds. There is no gain at all, so far as I can tell, to having a complicated portfolio of multiple mutual funds. There's no evidence out there that people that have more complex portfolios do better than those who have simple portfolios, and there's plenty of evidence that indicate that in fact they don't. And as we've already pointed out, there's absolutely no evidence that managed portfolios do better than portfolios based upon index funds. That's been true for 20 years. That one hasn't really done any better than the other. So if you have 4 mutual funds in your portfolio or 5, that's all you need to have. So long as one of them is either S&P 500 or something like the big cap representation, because that's the one that performs the best over time, and at least 2 representing bonds, not 1, because the bond portfolio has to be broken down where it has a short maturity alternative and a long maturity alternative, because you should know about this, enough about this now, that bonds per se offer opportunities for capital loss if they are long-term and you have a scenario where interest rates are rising. So you need to be able to move back and forth between short and long maturities.
Why are you recommending mutual funds instead of ETPs?
Well, ETPs are just fine. For example, if you're realistic about it and say, I am really only going to use SPY and IWM and stuff like that. The problem with ETPs is they're so tempting to get into the more marginal stuff, right? And then also in the case of the bond ETPs, and this is a big deal, remember I talked about it, the issue of liquidity of these things has never been tested for bond ETPs that are at least below investment grade. I think if you're in a bond ETP like SHV that is treasury securities, like short-term treasury securities, no problem there. But if you get into mixed bond ETPs, and especially below investment grade mixed bond ETPs, or not even mixed, just below investment grade, then you have the potential for a liquidity problem in a crisis, and that has never been tested yet because these ETPs are so young. You won't have that problem in a Vanguard mutual fund, and that's why I urge that. But if you know what you're doing, there's no reason not to do this with ETPs. So what I often tell people to do if you're trying to minimize this is just never touch the index fund, the core at it. Just let it grow. And change your composition by changing everything else. Just leave the index fund alone for the largest part. Don't generate capital gains out of it if it's it's in a taxable account. Just leave the index fund alone, and if you can do that, and just tamper with everything else. You use your money market mutual fund, which remember is a discounted asset, which these days has a yield of close to 0% as your buffer. So when you actually, when you have a fund family like Vanguard, you can just log in and sell out $100,000 of some index fund or some sector fund, and you can move the cash directly over into, say, a bond fund. That's easy to do in a mutual fund. But you may not want to do that. You may not be sure of where to put it. So you can use your money market mutual fund as a buffer for that for the time being. Say, I know that what I want to do, this is an overheated market. I want to move $250,000 out of my equity representation. Until I figure out what I want to do with it, then I stick it in a money market mutual fund that I have there. And then later on, I'll decide where I want to park the money. And so most people, I think, tend to do that. I tend to do that myself. And so you use the money market mutual fund or a very short-term U.S. Treasury fund as a buffer as you move your money around. And you can move in and out of sectors or fund classes because, again, if because of your employment or because you're simply smart and read a lot, you understand that certain sectors outperform others, then you may want to invest in sector funds as a consequence, those sector funds that you think will do better than the market as a whole. I have, at times, myself beat the market with sector funds, notably, as I pointed out by example, when gold and oil service companies were running after 2003 up until about 2007. That outperformed the market by about literally triple what the market was doing. So every now and then you can get a feel for this stuff, and if you've got a feel for it, you move into the sector fund, like biotech or something like that, then go ahead and make your play. As you move along, though, as your successful category begins to grow in relative importance for the portfolio, you have to periodically consider about whether you want to take profits and back it down. That's going to be, in many cases, the source of the rebalancing. So, for example, you go into gold or oil services like I did. There was a time when you say, let's leave it there. It really seems to be running. But then on the other hand, after a while, it begins to look like this sector is not going to grow like this forever. At what point do I want to run this balance back down and rebalance the portfolio? So in doing that, you leave your index funds alone, but you pull your sector funds down after you think they've had their day. And there's no sector out there that just continues to perform forever. They all eventually have their day. And so you've got to try to figure out when you're going to get out of yours. Even stocks like technology stocks are getting pretty long in the tooth right now. There's no guarantee that Apple and Google and the like will continue over the next 20 years to perform as they did in the last 20. I don't think that's very likely because they're turning into cash cow companies for one thing, and they don't experience, nor can we expect them to experience, the torrid growth that we saw that justified those steroid price increases that we've seen for the past 20 years or so. You may have seen the original founders of Google, because of the complexity of what that company has become, bailed out yesterday and are no longer CEOs of the parent company. That's kind of shocking to see and understand, but it's also understandable that that's true. So when you do portfolio balancing, it kind of works like this. So let's say you start out at 60-40, and then because the stocks typically in normal times outdo the bonds, 3 years later you're at 70-30. And so then you can say rebalance to 65-35 in a series of steps until you say get back to 60-40. And so you can do that as a single step, you can do that as a slow series of steps to basically keep this in balance. But you can't start at 60-40 and ignore it for the rest of your life, because after 10 years, it'll be 85-10 or something like that. So you want to rebalance it from time to time. So this is not a very useful graph, but basically it shows you what the performance of your portfolio is going to be if you start at 60-40, but stocks are yielding 1% per month and bonds are yielding 0.5% per month. And so every 2 years you take capital gains in stocks and rebalance to 60-40. Your portfolio will kind of look like the jagged red and jagged blue. And I do this. I've done this all of my life, by the way. You take gains in capital stocks, you roll it into bonds, and pull your composition back down to 60-40 or 70-30. And effectively what it does is lock in capital gains. Now, so you say, well, that's pretty simple. We got this split between bonds and stocks, so we can keep this straight. But again, we know from Chapter 8 that there's a problem with the bond component, that has to receive special treatment. And this is critically important that you understand this, especially right now. So on the bond component, you say, well, the problem with the bond component is it's always been presented as investment income, as they call it, as a safe bet and all this. Whereas in fact it's not. The safety depends upon the ratings of the bonds, and it depends upon their maturity. And given those two things, it depends upon the current interest rate structure and where it appears to be going. Because if you're talking either about below investment grade bonds, or if you're talking about long-term maturity investment grade bonds like treasuries and AAA corps or something like that, if you're in an environment where interest rates are unusually low and destined to rise, then we showed in that Chapter 8 lecture that you're going to suffer sizable capital losses in that bond portfolio. I don't mean 5%. I'm talking about 20% or 25%. That's how much those bonds can be affected by a move from these currently artificially low rates back to even historical market rates. And then if there's a move that's motivated by an inflationary impulse, then the capital losses you're likely to see are more along the lines of 40 or 45%. I remind you that we bought way back when, 2005 maturity bonds for 68 cents on the dollar in the 1980s in our family. We were able to buy them for 68 cents on the dollar because the inflation of the 1980s pushed those prices down as market yields on bonds rose. And then later those bonds matured at 100, although we sold them long before that for about 120. So we actually doubled our rate of return on the bond, and during the time we owned it, we earned 14% interest on top of the double capital gain. So timing bond purchases is more important than timing stock purchases. But this means, of course, if you're moving your portfolio into bonds, you have to pay attention to the composition of the bond part of the portfolio. And it can't really be represented by a single mutual fund or ETP. It has to have some short and some long representation. And in my opinion, it literally should have four components: the money market, which is your buffer part, then the ultra short treasuries of up to 2 years, then intermediate treasuries from say 2 to 7 years, and then longer stuff 7 to 30 years. And if you have those three types, then you kind of reallocate based upon where interest rates appear to be going. So if you take a look at normal condition, if you look at this slide that's on the upper left for you, then if you got a 60-40 portfolio and you have normal interest rates and no belief that interest rates are either rising and falling, then your stocks and these four portfolios that I'm talking about would be equally represented. 10% of each in the 20 plus, 7 to 10, 3 to 7, and the bills. But if we have rising interest rates or anticipation of rising interest rates, which is where we find ourselves right now, then you don't want to have anything in 20 years. You don't even want to have anything in 7 years, because you know those are going to result in capital gains. We looked at the prices of these bonds at the end of Chapter 8. We see that the current market value of all these long-term treasury bonds is above $135, and Tilt itself is quoted characteristically at above 140. And so the reason for that, of course, is that long-term interest rates are at near historical lows. And when they rise back to higher levels, there's going to be huge capital losses in that. And there's no way that interest rates are going down anymore, or at least not very much. And so it's senseless to have any ownership of long-term, intermediate to long-term bonds now, 7 years or out. In a falling rate environment, however, and this is something you do have to remember, or you should remember if you really want to make this portfolio outgrow the market. If you do have a bad market like we had in 2009, beginning 2006, effectively collapses in 2007, then 2008 accelerated in 2009. And the stock component of the portfolio, whatever it happens to be, is just been beat to a pulp. You know that's going to recover. And so, as I said in the last lecture, you want to try to figure out kind of when that is and start building your balance in the portfolio back towards stocks. But the other thing to remember is at the time this is all going to hell, because the market's peaked out like it might be, say, 6 months from now. Normally, the bond part of your portfolio has got to be 100% long term. Because if interest rates are high, the way they normally are prior to a recession, middle to high prior to a recession, the Federal Reserve System, in reaction to the recession, is going to push those interest rates down. And for that reason, you want to have your bond investment almost entirely in long-term bonds, because you'll get massive capital gains while everybody else is losing money hand over fist if that happens. But there's a warning about the contemporary period. As I keep pointing out, the reason I'm critical of current Federal Reserve policy is because they should be raising interest rates as they said they were going to do in 2014 and 2016, so that when we have a recession, they'll actually be able to drop them, as I've just said, but they haven't done that. Instead, they've pushed interest rates right back down where they're hovering just above zero. So if we move into a recession now, the very policy that I told you you could profit from will not be exercised this time around, because they don't have the means to push interest rates way down when they're already at zero. And so, but in the future, on the other hand, if we ever return to normal, which is doubtful in my mind, then when the economy is going into a recovery, you want to be in long-term bonds, because the recovery is engineered by dropping interest rates. That means you get these big capital gains. Remember, the bonds that we looked at the quotes for at the end of Chapter 8, where we had the actual quotations from the Wall Street Journal, we were just going down the page, the 2043s, the 2044s, the 2045s, all at 135, 137, 133. Those bonds were all issued at par, or as you know, just slightly off of par, right? And so they went from par to that level. And the only way that's possible is if interest rates came down during their lifetime, which is exactly what's happened. So you say, well, then what is the implication if rates reverse? Well, they'll go right back down to where they started, if that's true, or even below. So you have to take that into account when you rebalance into the bond part of the portfolio. The bond part of the portfolio has to realistically reflect some sense of where you think interest rates are going. If you have no sense of that at all, then just go and balance them out again, or just be content to use, say, 5-year notes or something like that and live with it. But you're costing yourself a lot of money if you invest that way. All right? So this is an example that I set up for a young, affluent investor in November 2015 as kind of typical. The money market fund, short-term treasury, 500 index Admiral shares, high dividend yield index. I like dividends for long-term too, so remember that. My wife is a big-time dividend investor. I'm astonished at the dividend yield she gets on this stuff, because she buys stocks when they're low and during troubled times and does not sell them. So you can look at something like British Petroleum right now, which is unimpressive. Its dividend yield is only about 4%, but she bought British Petroleum in the downturn when it was 1/4 of what it costs now, so her yield is 13%, and she'll never sell it so long as it's yielding 13% on her investment. So in downturns, as I said, when everybody's running out of the theater, the first thing you buy when you're running in is dividend-paying stocks, because in many cases they're able to keep their dividend up. And based upon that price, you look at it, it's got a yield of 5%. You say, well, that's not all that good, but that's 5% based upon a depressed stock price. If you buy that and they keep that dividend payment up, and the cost of the stock goes up, then everybody else is going to be earning 3 or 4% where you're earning 5 or 6, and then they increase the dividend during good times and whatever, which is what happened to. She even makes dividends good return on Intel on dividends. That's because she bought Intel for 1/4 of what Intel's selling for now. So if you rush into the theater, you say, what do I buy? What do I buy? The first thing you look for is dividend stocks, because you can get them and lock it and do a pretty good job. Now, I did want to tell you that the rebalancing theory that I tell you about is not agreed to by everyone. One of Charles Matlack, who stays in touch with me a lot, class of 04, sent me an article that challenged the rebalancing strategy. It just dumps it on its head, says you should never rebalance, you should stay with stocks and all that. So in other words, if you start with 70-30, if it goes to 90-10, just leave it at 90-10. And he asked me to comment on it, so I had time, and I wrote back, and I did comment on it. There's a link if you want to take a look at it. And he asked for my opinion about this, and this was actually written, I wouldn't have said anything except it was written by the very famous William Sharpe. And William Sharpe is the author of the Sharpe ratio, so this is a big time name, right, that's saying that your approach on this is wrong. And Sharpe's opinion about this is that if you are selling out rising stocks, that you're making a contrarian bet. Basically, you say you're selling your winners. Why would you ever sell your winners? This is the argument that he makes. And I think it's very easy to refute because they don't continue to be winners. This is a cyclical market. It's more like a sine wave than a trend. And so although they have been winners for a long time, at some point that dries up and the market turns down and they're not winners anymore. Besides, 90-10 does not represent an adequate risk profile for somebody who's 55 years of age, period. If you're 55 years of age and you've got $1 million exactly socked away and you say, well, if nothing happens to that, I'm going to have a great retirement. And then we have a repeat of the market catastrophe that we saw in 1999, for example, then that $1 million turns into $200,000 and all of a sudden you have no retirement money. And you say, well, it'll come back. You know, it's not going to come back for you. You're 72 years old. You're going to die before it comes back. And so this is not what you want to do. You've got to pull that money out of the market now. In that market, by the way, I was managing money. I still manage this account for a friend of mine whose wife passed away and left him a lot of money. And so I started managing that money in mid-1999. And it was a pretty sizable chunk. And so he wanted to put it in technology stocks, kind of, because that's what everybody was making money on. I said, we're not putting a penny of this in technology stocks. Because technology, this is retirement money for you, and he was up there in years already, and technology stocks has had its run. So he pestered me, so I said, okay, I'm going to put $25,000 of this amount in the T. Rowe Price Science and Technology Fund. And that's all I'm going to do, though. And he's happy with that. He just wanted to have some representation in technology. So anyway, the market not long after had its big drop. And he wasn't hurt at all because we went into long-term treasuries right at the time of the drop, and the gain in the long-term treasuries exceeded the losses in what was fairly underrepresented stock portion of the portfolio. But the point is that T. Rowe Price Science and Technology Fund, in which we invested exactly $25,000 in cash, in 2003, was trading for $3,400. So if you want that to happen to your entire portfolio, $25,000 to $3,400, then be my guest, leave it all in stocks all the time. But on the other hand, if you're 65 years of age, that's relatively senseless. So rebalancing, I think, from my perspective, should be a part of the portfolio. So, and this is what I actually wrote to Charles. I said my advice to rebuild is qualified. It's intended for investors who are not confident that they can beat the market or want a simple formula that will give them some peace of mind. I fundamentally stick by that advice. My advice is contingent upon my theory that it is absolutely impossible to pick turning points. That's what I said to him, and I still believe that to be true. It certainly is for me. Even when given a wide latitude for a date range, like will there be a major market correction in 2018? You ask yourself the question, will there be a major market correction in 2020? You tell me, yes or no. You know a lot about the stock market now. You've taken this course. Tell me what it's going to be. And you know you're not going to have any confidence in whatever answer you give me. It could be either way for all you know. And I don't have any confidence in it either. But do I rebalance? No, or not exactly. I often rebalance, but not systematically. But I'm an aggressive market player who knows his own strategy, which is very complex. So I don't systematically rebalance the way I'm telling you to. But on the other hand, I'm a major market player, right? I do short-term trades all the time. I'm in the market every day. And so I rebalance in a timely way where I actually am sort of getting a feel for the market and the like. But I have 15% of my portfolio invested in options-based, hugely risky and highly leveraged swing trade bets. I squeeze the risk out of my main portfolio and try to get yield out of dedicated leverage bets, which right now are earning strangles, deep in the money leverage calls, which are yielding far above 100% for 2017. 2017 was just coin the money type of year for the option style betting, because it was a momentum market. All you have is you get the leverage, just stay in the leverage and stay long, and you just made money hand over fist. Because it was a high momentum, low volatility year, which is very rare. 2019 has not been a year like that. I'm actually down for the year on the option style betting that I've done, about $20,000. But that's the way it is. On years like this, you can pretty much anticipate that. So it said, I am willing to invest a considerable time and now modeling to do this. I advising young women who are not willing to do that. So that was my response to Charles. So here now is a few things you want to say about these major investment categories to summarize what you have learned. And I'm just telling you in summary what it is. This is the long-term investment objective we're talking about here, to try to help out your grandkids, maybe in the way that to some extent you were helped out. So what did we learn about stocks? Well, stocks have historically, with real estate, the highest yields on average in the very long run. Stocks in the long run do outperform bonds. There's no doubt about it, right? They outperform real estate unleveraged, but they don't outperform leveraged real estate. They can't. There's nothing that beats leveraged real estate, as we pointed out in the very last lecture. There is considerable volatility in these, though, and long periods of poor performance in stocks, and we saw that. And there's always a danger of a substantial and lasting crash, and an unpredictable crash, I might add. As earnings goes, so goes the market, which implies that as goes economic growth, so goes the market. Now, this is an economy now, and once again, part of this 10% versus 90% stuff. This economy is not a very strong economy. No global economy currently is, not even China. All the economies are performing subpar, because the GDP growth rate of this economy is nowhere near the torrid growth rates we saw during the early part of my life. 2.5% is now regarded as a good year, but that's not true for profits. Profits have never been growing faster than they are at the current time. And this, to some extent, explains this dichotomy of wealth and income. Wages are stagnant and have been stagnant for a couple of decades, really. But income from profits, income from stock investing, income from wealth allocation has been very strong, because corporate profitability, especially technology corporate profitability, has been very strong. And that will likely continue for a while, although it is going to dial back some. Because the markets, like earnings growth, the markets have been doing very, very well in general. This is one of the longest lasting recoveries we've ever had from the stock market point of view, 2009 up until now, with no significant downturn in that entire period of time. We do remember that these markets and stocks perform poorly with inflation and with rising interest rates. And if you take a macroeconomics course, you realize that we're setting the preconditions for inflation in the modern era with these easy credit policies that has been part of what's been keeping this economy going. And so, again, I must have said this now to you a dozen times, I anticipate that you will see one or two substantial bouts of double-digit inflation in your lifetime. And it will change the look of everything when that happens, and especially the look of your finances. One of the reasons you need to get into real estate, in my opinion, at an early part of your life. Because in real estate, you don't care about inflation. You go out and cheer inflation on. You get inflation pom-poms and say, bring more of it on, right? Because I'm getting rich because of this inflation, because of the leveraged inflation in the value of my real estate. As I pointed out, I was about to tell a bit of a story about this, but I'll tell it when I get to the real estate section about the real estate component. So it looks good for long periods of time, and then it looks terrible for whatever reason that happens. And that is the nature of stocks, and you have to make sure that the timing of when it looks terrible is not about the time you turn 62 or 65 or begin to retire, of course, or when you want to pass it on to your children. Even as you get older, you don't want the wealth that you build up over your lifetime that your own children and grandchildren can inherit to dissipate because of bad investment decisions. Now, on bonds and notes, it's simple, right? Really simple. This is not the sort of stuff that mud math is required to understand. The models requires mud math, but the generalization that arises from the application of the models is trivial. Market values of yield-bearing financial assets move in the opposite direction of interest rates. And it is leveraged by longer maturities or by lower ratings. The longer the maturity, the greater the sensitivity. And so treasuries, as we know from the last exam, also have market risk. They're no different than anything else. Non-treasuries also reflect default and other risks. And again, that has been quiet for an unusually long time. And when that stops being quiet, it'll happen overnight. It'll happen shockingly fast, as it has every other time in the past. All of a sudden, you'll be looking at a quiet market for junk bonds, and then 3 months later, you'll look at a completely illiquid market for junk bonds, possibly. And therefore, again, I say, because that's true, and because you won't have the means to react to it, you won't even recognize it for what it is, unless you sit on top of the financial news every day. You should not have any portion of your portfolio invested in anything below investment grade bond assets. And in my opinion, you shouldn't even invest it in investment grade if you have treasuries as an option. That way you can be a little lackadaisical and not catch the downturn and not be victimized by it. So, and that's very contrary to common investment advice, by the way. Almost everyone else says, oh yeah, you can invest in treasuries. You can invest in investment grade or even junk so long as you are prepared to get out of them when it turns bad. But you won't be prepared to get out of jack squat. Let me tell you, that's just not the way this world works. You'll watch it go by and see it collapse, and you'll sort of, like I say, like a frog boiling in water, you say, well, why didn't I sell those a month ago? That's the way it works when people are involved. The yield you earn in interest is determined at the time you buy the asset for that asset, right, when you buy a bond. A diversified portfolio should include treasuries. In fact, it should be, in my opinion, the bond part of your portfolio. But you buy bonds when interest rates are high and notes and bills when interest rates are low, more importantly, where you think they're going to go. And inflation will devalue bonds, but bills, shorter term bills, and notes, like 2-year notes, they follow inflation up. And so you say, oh my God, what do I do? I've got my house, I'm okay there. What happens if I have an inflation? 2-year bills, 2-year treasury bills will just follow the inflation right up. If the inflation goes to 20%, they'll yield 22%. If inflation goes to 30%, they'll yield 32%. So that won't be true of long-term bonds. Long-term bonds will be in a total state of collapse during an inflationary episode. Stocks will be too, so you run to short-term treasury bills during an inflationary period. Okay, what to remember about real estate? Real estate's typically leveraged, and that makes it the high return investment. As I say, unleveraged, it doesn't perform as well as stocks, but it still performs pretty well, and leveraged, of course, it completely outperforms stocks. The real estate buyer must be sophisticated, intelligent, informed buyer. This is not the same easy market that it used to be. The demographics in this country are changing. And so you need to kind of understand these markets before you just rush in and start buying. And you know that, of course. And your parents would tell you that too, if you asked them. If you only remember one lesson from this course, it's this one. Real estate is a necessary hedge against inflation. You have no hedge against inflation if you don't have real estate, unless you're already wealthy and you've got it in titanium coins or gold or something else that would do well during an inflation. Real estate can be dangerous because of the leverage, and you know that. Most failures in real estate are due to cash flow failure. That is to say, the cash you need to service the loan payment dries up before the loan payment can be made, and down goes that house of cards. Not having sufficient cash to service amortized debt. So you know that. And there are times when not to buy real estate, and there are places where not to buy real estate. Finally, real estate, and you'll understand this when you start to realize that real estate offers tremendous tax advantages. One of the huge liabilities of you basically graduating directly into the upper 10% of income earners, which is almost literally where you are, because the median graduating income from this college is $87,000 a year, and I just showed you that the cutoff point for that's 118. So you say, well, I'm not in that then. You're not in that for the population as a whole, but for your age cohort, you're in the top 1%, right? And you'll be in that before you can count. The liability of that is you'll have a huge tax burden, and I anticipate because of this very issue that I'm raising that tax burden will rise in your life very quickly, because one political solution to this wealth and wage imbalance will be higher taxes on wealth and on income, and that means higher taxes on you, and your income tax burden is already going to be quite high because you're in this group to begin with. Remember that real estate offers an escape from that under current law, and that ends up actually for you being very important. Your parents will tell you this too. They'll say, well, yeah, doesn't everybody know that? Yeah, no, not everybody in fact does know that, but now you do. Then mutual funds and ETPs. So we're back to the question that was asked just a minute ago, right? This is where you're going to be invested because of the way investment accounts work in the United States. So do your research and understand investment objectives. I talked to you about the danger of paying fees you don't need to pay, and the video lecture that I'm concluding with, that I'm asking you to watch, is mostly about that very subject. I point out by example what is going to cost you if you get lazy and don't do your own mutual fund investing and allow investment advisors to do it for you. I show you what that costs you over 35 years if you do it that way. So I won't say any more about that because I really strongly make the point in that video. You should strive for portfolio balance, and you should consider rebalancing periodically to stay on top of your portfolio. For one thing, it forces you and your spouse to look at your portfolio, and you should do that. You should examine your wealth. That is also talked about at length at the very end. It's important that you do that. ETPs can be viable, liquid, and marketable substitutes for mutual funds, but beware of future-based exchange-traded notes, and remember why that's true. You know enough already to completely not have this problem, right? You know the distinction now between futures-based ETPs and traditional ETFs like SPY and gold and the like. You can tell the difference already. So you know that the latter are just fine and the former are ill-advised for an investment portfolio. And again, ETFs have suffered liquidity events because we saw that in the flash crash in 2010, and I anticipate we may see it again in bond-based ETPs, especially below investment grade in the future. They have never been tested because they're brand new, and they've never survived or been through historically a market downturn. And it's inconceivable to me that they won't run into serious liquidity problems in the next credit crisis. What to remember about derivatives: if you're good at this, and some of you will get into this stuff and like it, then playing puts, calls, and or futures can possibly supplement compounded rates of return on your portfolio by a few percentage points. I mean, first of all, many of you are being hired away directly by these large funds like Virtu and Renaissance Capital and Headlands Technologies and Citadel. They've been around for a long time, and they make way more money than these markets make. So there are means to make a lot more money than the market makes as a whole, investing in the S&P 500. But they are pulling in the absolute epitome of brain power to calculate that. They hire the best of the best of the best only because that's what they feel that they need to run these trading algorithms and the like, right? So you have that capacity. You can do it whether you work for them or you work for yourself, potentially. So consider it, although it's, you have to dedicate yourself to that. It's got to be something you want to do, just like entrepreneurship. It's an issue of whether you really want to do it or not. And if you don't want to do it, forget about it. Don't do it. You'll never pass the criteria unless you're really driven to do it. But if you are, then you'll do a lot better than investing in the S&P 500. And you might find that it's kind of fun. The derivatives require an active, aggressive investment attitude and dedicated attention when you're in a position. It is hard to trade this stuff. You have to be all over it, or you have to write computer programs that simulate that for you. There's no other way to do it. Writing covered calls on stock positions can be a good way to supplement yields on a portfolio, but even there you have to have pricing and valuation algorithms to make sure you're writing the right kind of calls. I do recommend to you, if you go this route, that you start at a young age by building up a Roth IRA and maximizing the contribution to that Roth IRA every chance you get. And then, if you do this kind of high yield, potential, high risk investment, do it in the Roth IRA. Because if you hit a home run, it will not be taxed, ever, right? It won't ever be taxed. If you do what the winner of our portfolio competition did, and in September, well, he did it, you buy a stock for 80 cents a share, and then in December, you sell it for $5 a share, and you make $50,000, as he did in his simulation, and he's the only one who did it. So if that's in a Roth IRA, not a penny of that gain is taxed, ever, period, right? So that's what you consider.
So Roth IRAs get taxed when you put it in or when you take it out?
Neither one. Roth IRA, you get no tax deduction when you pay in, but you have no tax going out. So there's no tax ever on the gains in a Roth IRA. Ever. Okay? And these are risky. So the remaining slide is about the more about this attitude sort of stuff, going into it, whether you're suitable for that, and then just this hammering lecture on fees and what it's going to cost you if you don't do it yourself. I just iron out these scenarios and show you what it means to do it yourself rather than rely upon an investment advisor who's probably not even qualified half the time to do it anyway. So you can see that for yourself. It's posted now. You can find it. I also forgot to tell you that the term sheet for the terms for the final is also posted if you want to look at that. Remember last time for the second exam you had that sheet and you had the last 20 questions based upon those terms. The final term sheet is posted on the website now, so you can see what the terms are. So when I was in high school, I had a friend, Armenian friend named Charlie Bacalian, who lived in Fresno. And he was influenced by an uncle who was a real estate investor, kind of small-time Fresno style. He used to lecture me and Charlie about, you should invest in real estate because real estate, is you don't put only so much money down. You buy something worth 10 times as much. It goes up a little bit in value, then the rent pays for itself and all that. So we were like listening very attentively to this advice offered by a guy who was probably in his late 30s or early 40s at the time. He was doing this. This would have been in the early 1960s or so. So Charlie was head over heels convinced that this is the way he had to go. So Charlie and I joined the Air Force and the buddy system. We were both drafted, but in 1966, if you were drafted, you had the option of joining the Air Force or the Navy for 4 years, or be drafted into the Marine Corps or the Army for 2. We didn't want to go in the Marine Corps or the Army, so we went in for 4 years on the buddy system, went to basic training together, went to Vandenberg Air Force Base together after that, and then I was shipped down to Panama in 68, and he stayed in Vandenberg. And so we sort of split up, and he was discharged 9 months before I was discharged. I was discharged on the 4th anniversary of the day I joined, April 12th, 1970. And so by the time I got back to home, the first thing we did, look him up, was catch up on old times and all that stuff. And he owned 2 little houses that he had bought near Riverside City College. And so he bought those after he was discharged and before I was out of the service. And I remember one of the homes very well. We visited, it's a little tiny house. It was built in the 1920s. It's about 1,100 square feet. And he paid $10,000 for that house. And he paid $12,000 for a house nearby that I don't remember ever seeing. And he did it with about 10% down or something like that because I think his relatives lent him the money for the down payment. So all he had to put down was about $1,000. Although $1,000 back in those days was a lot of money, because my income, I remember those years, was like $300 a month, right? So it's 3 months' income. And so that started his, and I was really excited about the whole thing. But in contrast to him, I was just married, I had no money, and I had no access for down payment. And I also was resolved to go to school, go to college, because I hadn't gone to college before the Air Force. And then I kind of got interested in going to graduate school. So I never had any money to invest in real estate in my early years, because I was married, broke, and going to college. Charlie decided, in contrast, that he didn't want to go to college because it would kind of interfere with what he was trying to do. He needed a small, steady source of income for a few years until he could build up his real estate empire. Well, everything that Charlie touched turned to gold. He's a very wealthy man today. And he followed exactly what his uncle told him to do. Started buying just as quick as you can, as early as you can, properties with leverage, and then keep as much cash as you can, repair them yourself, and then buy more and fix them, and buy more and fix them. And he did that, and he never got a college degree. He worked for the state of California at a job for just a few years, and then he relied entirely upon his real estate income. And I have no idea how wealthy he is now, but it's in probably above $100 million or so. And that's simply because he got it right from the get-go, right? And so, I read this stuff about the 10% versus the 1%, and I realize that I know, almost everyone I know literally is in the 10% or the 1% because of my background and where I'm from, stuff like that. And they didn't cheat anybody or do anything illicit to get there. They just made a bunch of really smart moves, when they were young. And this is a case of where the guy just got the very simple message. Charlie wasn't the brightest light in the factory, he was just a kind of an average guy. But his uncle would point this stuff out, and Charlie would sort of sit there and they would just drill it in. And then he just started acting on it at age 21 when he started building his empire. And he just built it and built it and built it and built it until he has something like 400 units or something like that now up there in the central San Joaquin Valley. And so it's a lesson, really, about avenues of wealth and avenues of income. And, I live in a neighborhood that's a sort of high middle income. The houses there average about $900,000. Some of the houses are about 1.5, 1.6, about the least expensive, 600, 700,000. And of all my neighbors that I know, only half have college degrees, about, I would say. The rest are in construction, trucks. The guy that lives across the street owns apartments, just like Charlie. A guy that lives catty corner has a truck washing service. Quite a few of the people are building contractors, prime contractors and stuff like that. They're all very, very well-to-do. Almost all of them are wealthier than I am. And they just, stuck to these core ideas for their entire life, and it resulted in this gradual buildup of wealth and income. And again, it's nothing illicit about it. It's just having a plan and doing something right and acting it out and having the character to live it out and to realize it. And the like. Most of it involved reasonably hard work, but not terribly hard work in every case. So I think if you approach this by saying, I have a plan that makes sense, you don't need to remember all the little details of everything I talked about. Just a general core message is all you need to remember. And you just execute the plan at some point, like my friend Charlie did, then go about your life as a Google engineer or as somebody who works for the SETI project or whatever it is, working on robotics or self-driving cars or whatever it is you want to do. And you will be someone probably who's able to provide well for your family. The one thing that I do encourage you to understand that you perhaps don't understand now, this sort of thing with regard to purchasing power and wealth and so forth that I'm talking about does not appeal to you very much now. When you get married, it'll appeal to you way, way more than it does now. And when you have your first child, it'll really begin to settle in. And if you have 2 or 3, some of you will, some of you won't. And when you have your first grandchild, it will be everything for you. It will be everything for you. Nothing will matter anywhere near the importance of that when you're 55 or 60 years old and you have a couple of 1 or 2 year old running around who pull at your shirt because they think you're the coolest thing going, even though you're kind of a big jerk or whatever, whatever you actually are. In their eyes, you're, God, basically. So that's when you say, damn, I'm sure glad I did it that way, because this is a world where if you're out there, it's remarkably dangerous compared to where it was even when I was your age. It's a world that's really getting to be a hazardous place, especially on a global situation, right? So you want to be able to protect your family and your kids, and having the wealth and the means to do that is going to become very important to you at some point. And 10%, 1%, let that debate rage the way it will, take whatever stand you're going to on it, but you want to be in that category, believe me, or you will want to be in that category when you finally have your kids and your grandkids, and you'll understand why at that time. So come back and say a few things on Monday to make sure we get it wrapped up and you're ready for the exam. Make sure you watch that video that still remains. It's posted there now. It's more about this very same thing I'm talking about right now, right? So make sure you watch it. It's one last hurrah to try to get you motivated to stay all over this stuff. And then we take the exam and then we're done. Okay?